All right. Thank you. So again, thank you, Lori, for reminding me about the YouTube channel. One of the really awesome benefits that's come out of us going virtual over the last 18 months or so is that we record almost every meeting, not every single meeting, but almost every meeting. And so now we have a really cool library of content on all different topics. So especially for beginners, it's a really great place to start. And we really, really want beginners to join. That's really who this group is for. I find that as I'm out in the world encouraging people to join the Austrian Women's Investing Group, some of the feedback I get from people is like, well, I don't know anything about investing, right? And what I try to tell them, and what I hope all of you, would tell people in the same boat is like, there is no assumed level of expertise in investing. We want beginners to join. Like, this is the place where you can come to ask any question. And this is the place where you can come to learn. That's like the exact purpose of this group. So we definitely need beginners to join. There's lots of material that's already out there that is available for free on the YouTube channel. And certainly, like, as we get more and more beginners, we also need people with more experience to help share their own experiences with the beginners. Because if you've ever been to one of our in-person meetings, it's really like, imagine a group of women sitting in a circle, sharing their stories with each other. That's how most of us learn. It's learning from each other, learning from the woman next to you. And so we try to recreate that as much as we can in these virtual meetings. I'm going to be leading the group today on just kind of a stock market review and stock market outlook. As you drop questions into the chat box, Lori and Gwen will go and review those questions in the chat box, and they will stop me periodically to ask the question that you guys drop into the chat box. So they basically know what topics I'm going to cover. If they don't get to your question right away, it's probably because there's a more advantageous place to address it further on in the slide deck. And my hope is that I tried to keep the slides to a relative minimum. You guys know I like to show a lot of slides and go through a lot of content. But for this one, I really wanted to leave a lot of time for Q&A, right? So it's my intention to cover some of the basics for beginners, but also certainly leave room for more complex questions, more complex topics. So that we can kind of hit as much as we can that's on your mind. So whatever question you have, drop it in the chat box, and we're going to try to get to it. Before I start, I just want to make very, very clear that nothing in this meeting is intended to be individualized investment advice, or legal advice or tax advice, if any of those topics come up. We are all here, including myself, we're all here to share knowledge and experience, but if you need advice for your own personal situation, you should enter into a formal relationship with a tax advisor, an investment advisor, a legal advisor to get the information that you specifically need. We've never had a problem before in this group, and I don't think we ever will, but I just feel compelled to say that every time. All right, I think that basically covers everything I was hoping to say in the introduction. And so Gwen, thank you. So Gwen unshared her screen, and now I have to figure out how to share my screen. So hang with me for a minute, everybody. I'm going to, you would think this would get easier after 18 months of doing it, right? But still, it's just not. All right, share screen, Sarah. Here we go. Now I'm going to present this. Hey, Gwen, can you let me know if you can see my slides?
Yeah, we can see the slides and we can see you.
Oh my gosh, is my head on the slide?
Yeah, this is a new thing, y'all. Like, we used to not see Sarah when she did her slides, but now she's like her little avatar in the corner. So this is very cool.
If you see my avatar, just know that I cannot see myself, so I have no idea what this looks like. I also don't know if my head is going to be covering up any of the stuff that I'm talking about. So this is so new, just hang with me. It feels very strange, but all right. Well, I'm just gonna go through the slide deck and pretend like everything is normal and wait for Gwen and Lori to interrupt me to ask questions. So, all right, let's just do it and not be super self-conscious about it, right? All right. Hopefully I can move my slides. Great. All right. So we will be sending out this slide deck for people. So just keep that in mind as we're going through it. Of course, you'll get this important info about the seminar, a lot of this disclosure language. Really one of the main things, especially when we're talking about the stock market, one of the main pieces of information in here and all of this kind of legalese language is the concept of past performance is not indicative of future results, right? So what that means is we don't know what's going to happen in the future. We have all of this information from the past, which is what we look at in order to make forecasts and projections about the future. But obviously the future isn't going to be exactly like the past. So we just have to always keep that in mind, especially when we're talking about the stock market. There's so much uncertainty that goes into making projections about how stocks will perform that it is always important to remember that past performance is not indicative of future results. But we're trying to learn and do the best we can with the information we have so that we can make decisions about how we invest our money going forward. Here's a little bit about me. I'll just say, you can find all this stuff on LinkedIn, on the BlackRock Financial website, on the Awesome Investing Group website, so I'm not going to spend too much time on it. And what I'm really going to try to focus on, which is really what I always try to do, is stocks for the long run, right? We certainly can talk about shorter term strategies and trading. I'm happy to share what I think I know about that topic, but I'm not a trader, though I know probably enough to be dangerous. But what I really focus on is the wealth building power of stocks over time, which is why this is my favorite topic to talk about in the Australian Women's Investing Group and in life. And the Warren Buffett quote that I love more than almost any of his other quotes is, someone is sitting in the shade today because someone planted a tree a long time ago. So what that means is someone made a decision a long time ago to plant a tree or to start investing in stocks or something like stocks. And if you give that enough time, eventually you end up with something big and beautiful, and you have resources at your disposal that you wouldn't otherwise have. I always like to start with that Warren Buffett quote. Really, really quickly, I'm not going to spend too much time on the basics of the stock market, but I at least wanted to have one slide that touched on these things just to level set and make sure that we're talking about the same thing. Okay, stock is ownership of a company. That ownership piece is really important. If you lend money to a company, there's usually a contract involved, and the idea is I borrow money from someone, I need to pay that money back. And if I don't pay it back, the lender can take me to court. They can take me to bankruptcy court. That's a really different relationship than being an owner of a company. When you own a company, you are not legally entitled to anything. You hope that the company that you're investing in is really good at getting new customers, really good at getting new sales, really good at generating profits, which we'll talk about in a minute. But if it's not, and the company doesn't do those things, you can lose your investment. So it's high risk, high expected return. And we'll definitely talk more about that going forward. But just think of it like I am an owner of a company. The price of a stock is simply where a buyer and a seller agree to make a transaction. The stock market is a free market. The price is telling us where a buyer and a seller have come together and agreed to make a transaction. What that means is if there are more buyers for a stock or a fund, if there are more buyers than sellers, the price will go up in order to entice more sellers into the market. When there are more sellers in the market than buyers, the price will go down until the price gets to a level where buyers are enticed to buy. So this is what happens all day, every day in the stock market. Stock market opens at 8:30 in the morning Central. It closes at 3 p.m. Central. And we're seeing this repricing of stocks continuously throughout the trading day. Some people really like that, and some people do not like it at all, right? But that's what the stock market and the prices of the stock market are telling us. Stock prices are always changing because investors' expectations about the future are always changing. We are always getting new information. So every investor, me, you, hedge funds, insurance companies, everybody is in the same stock market. We're all getting new information and we're all adjusting our expectations about the future. Are we optimistic? Are we pessimistic? Are we optimistic about a certain company? Are we pessimistic about a certain company? All of this information is continuously flowing in without end. So that's another feature of the stock market. And that is why it's kind of like this information overload, or this like trying to drink out of a fire hose for most investors. The stock market is only appropriate for long-term money. If you are in the stock market for long enough, these second by second repricings, they get evened out over time. So we'll look at some charts to show that. That's the easiest way to get around this information overload that can easily happen once you start paying attention to the stock market. So this is the perspective that I start with, is the stock market is only appropriate for long-term money. And in my perspective, long-term money is at least 5 years out. Ideally, it's 10 years plus out. So the thought process is, I'm investing this money, I'm going to put it in a time capsule, I'm going to come back for it and see how much it's grown in 5 years, or ideally 10 years, 20 years, 30 years. So for most people, this is appropriate for your retirement planning, and not just getting ready for retirement, but being in retirement. I think that most people hope and assume that they will have a long retirement and a long life, and you want to have enough resources to get from the beginning of retirement to the end of retirement. So just think of it like, okay, this could be an appropriate place to invest long-term money. On the shorter than that, it gets much trickier, and we can spend some time on that, maybe towards the end. Are there any questions so far, Gwen?
It doesn't look like we have any questions yet, so we can keep going for a bit and see if anything trickles in.
Great. All right, I just want to say that I kind of reordered my slides, so this is going to be a little bit of a surprise to me as to which slide pops up next, but definitely stuff that some of you have seen before, and but it's to kind of, again, level set for the new people. So in the stock market, I mentioned before that investing in a company, you want to invest in a company or a set of companies, a group of companies that are growing, getting new customers, adding new sales, generating profits. So I'm going to spend just a minute on the income statement. So when a company is publicly traded, that means that it's available for us to buy and sell. That company has to produce financial statements every quarter, and then a big set of financial statements every year. One of those financial statements is the income statement. It's also known as the profit and loss statement, or the P&L, but they're all set up basically the same, right? At the very top, there's a category called revenue. So this is also known as sales, or the top line, because it's at the top of the income statement. So imagine going into the Apple store and you buy a new iPhone. They give you an iPhone and you give them $1,000. Now, Apple will put that $1,000 in the category of revenue. So obviously, the more iPhones they sell, the more revenue they will generate. And this is true for any company, whatever the goods or services are that they're selling. Now the company has to start paying people, right? There are costs to doing business, obviously. The first category is cost of goods sold. So kind of think of this like cost of the raw materials that go into producing the goods that the company is selling. You have to pay your suppliers. You have to pay those. So there's a cost of goods sold category. Then the company has to pay something called operating expenses. So think of this like payroll, benefits, rent, software, utilities, things like that. So I like to think of it like the cost to keep the lights on, right? To keep the company operating. So there's a big category of operating expenses. There's lots of subcategories, but we're going to keep it really high level for the purposes of this. The next thing the company has to pay is interest on any money that it's borrowed. Companies borrow money all the time, and they have to pay interest on that money to their lenders. So there's a category for interest that comes out next. So now if there's any money left over, they probably have to pay taxes. And then after all of those other people have gotten paid, there's something at the bottom called earnings, right? So these earnings are also known as profits, net earnings, net income, and the bottom line. I found when I was just starting, this interchangeable vocabulary was really confusing. It took me a really long time to figure out that all of these things at the bottom, earnings, profits, net earnings, net income, and the bottom line were all the same thing. And that revenue was different, right? So if this is the first time you're seeing it, awesome, right? If this is the 10th time you're seeing it, just know that as we're going through and talking about stocks, the most important number for shareholders and stock owners is this earnings number at the bottom. This is what is going to drive the price performance of stocks in general. So I'm going to keep going with this and just show you what I mean by that. Those of you who have ever seen me do something like this before, either in a class or in the Awesome Women's Investing Group, know that this is my favorite chart of all time. So what this is showing is that relationship between price and earnings. And I really think once I saw this chart, maybe for the first time, maybe it's 10 years ago, it's really solidified in my brain what we're talking about when we're talking about stocks. So I like to show it every time I talk about stocks too, because hopefully it will help you. So what this is showing on the gold line, the gold line is showing something called S&P 500 earnings. The S&P 500 is a broad measure of the US stock market. It's basically 500 of the largest US companies that you can buy their stocks, right? So it's a list of 500 companies. Think of it kind of like being in a basket or being on a list. So like I mentioned before, every quarter, those 500 companies have to release their income statement, right? They have to release their earnings statement. So it is possible to add up the earnings of all the companies in the S&P 500. And Standard & Poor's actually does that. This is information that any person can get. So this gold line is a chart of S&P 500 earnings from 1988 until last quarter, 2021. And then it's even showing some projections about where earnings might be through the end of 2021 and even into 2022. So we can see that earnings, if you really zoom way out, you can see, okay, earnings trend upward over long periods of time. The US economy tends to grow over long periods of time. But you can also see like, okay, there are plenty of periods of time where those earning numbers are falling, right? For any number of reasons. There's a recession, changes in the business cycle, changes in the interest rate cycle. The earnings don't only go up, right? They also go down. So that's what the gold line is telling us. This white line is the price of the S&P 500. So if you listen to like Marketplace or watch any sort of financial news, this is the number that they tell you every day when they say the S&P 500 closed at 45.10 today, or the S&P 500 was up 1% yesterday. They're telling you the price of this basket of 500 stocks. So we can chart that too, because it's just being continuously updated through time. So we can see the price of the S&P 500 over time. And I think that you can see pretty clearly that there is a relationship here, and it's a pretty strong relationship between earnings and price. It is not perfect, but it is a very strong relationship. So I always like to come back to this slide because a lot of people tend to think of the stock market like a casino, right? Or like a zero-sum game, or some sort of short-term game that you need to know the special rules of in order to play. But what the stock market actually is a reflection of companies' ability or inability to generate profits, not just now, but even more important, in the future. Because the stock market is also a forecasting tool. when we're investing, we're trying to make predictions about the future, right? We're taking money we have today and we're trying to put it in the right spot that gives us the best chance of making money in the future. So the future is always the most important thing in investing. What do you think is going to happen in the future? Here on this chart, we see these gold boxes. So these are estimates of earnings. Wall Street is full of people who are trying to project what earnings will be in the future. And that's what these boxes are. They haven't happened yet. So we can see here that, okay, in 2021, it looks like, let's see. I think that these are from Yardeni Research, right? Yardeni's projections are that earnings in 2021 will be something like $200 per share. And next year, 2022, that there will be further growth in earnings. And that's what this box is here. Now, if we look at the white line, you can see that white line is pretty well, generally speaking, tracking the gold line. The white line is anticipating these earnings that haven't happened yet. That means investors are looking forward to the next 12 months or 18 months and trying to figure out, are things going to keep getting better for companies? Or are we going to get an ugly surprise and maybe these projections for the future come in worse than expected and the box actually ends up lower than where it's projected today? So because we're talking about the future, any change in these expectations has a dramatic impact in the short term on the stock market. There's no doubt about that. I think maybe some of you were on the call that we did. I think we did this in March of 2020 last year. And I think we did it again towards the end of the summer. People's projections about earnings after March of 2020, earnings projections were all over the map, but they were almost universally pessimistic, right? There's a global pandemic. How are companies going to make money? Everybody's going to lose their job. This is going to be horrible, right? The stock market is going to be bad because profits are going to be bad. Everything is going to be bad. But the market kind of pretty quickly changed its mind at the end of March. The Federal Reserve came in and said, we are going to support the economy. Congress passed a bunch of stimulus, getting money into the hands of people. And when those things happened, people's perception of the stock market shifted very, very fast. Oh, okay, maybe people are going to lose their jobs, but maybe they'll still have money. They're not going to have to sell their house or sell their stocks or, sell everything they have and be forced into poverty. Maybe we're going to give them money and we're going to avoid that part of this recession. They put money into the hands of businesses, right, to keep businesses afloat and keep businesses moving, right? That had a very positive impact on the stock market, and it happened really fast. So these are just some of the dynamics to keep in mind when you're in the stock market. One, we're looking forward. Two, people's expectations can change very quickly. And if you kind of get into the habit of trying to predict which way you think things are going to go, it is really easy to be wrong. And I say this because I've been wrong so many times over my investing career. We call it getting whipsawed, right? That just those expectations can change on a dime. And it seems at the time, they don't seem to make sense at the time, but when you kind of get the benefit of hindsight, you can see why the stock market reacted the way it did when it did. That makes it incredibly difficult to make predictions in the short term. It is so challenging. That's why I always focus on the long term, because this chart, it's easier to make predictions if instead of looking into 2021 and 2022, we start thinking about 2030 or 2035, right? If you think about 10 years, 15, 20 years out, you're like, well, okay, these lines are probably going to continue trending upward over time with lots of volatility in between. So the path will be generally upward, but we don't exactly know how we get from here to there. But what's great about it is if you're just in the market for the long term, you don't have to know how the market gets there. You just have to have faith that it will get there eventually, and that through these market cycles, all the recessions, all the interest rate regime changes, all the terrible things that happen, that we'll get through it somehow, and that companies in the United States are incentivized to create goods and services that people want. They're incentivized to generate profits, take risks in order to start companies to generate profits, because if a business is good at doing that, its owners disproportionately benefit. That's the stock market in a nutshell. So I know I just said a whole bunch in a kind of a short period of time. So I'm going to take a minute and see if any questions have popped up while I've been talking.
So we do have a couple questions. Amy asked, what does it mean when price outpaces earnings like it shows today, like in the chart?
Yeah, that is a really, really good question. It means that one of the phrases that we use kind of in the investing world is good news is already baked in, right? News is already baked into the price. So if I'm looking at this chart, thinking like, okay, the white line is already up to the level you would expect it to be if it was 2022, right? So the stock market is predicting that in 2022, S&P earnings will be somewhere around $220 per share. Estimates are always wrong, right? What we most fear is that earnings estimates are wrong on the upside. So what that means is that we're too optimistic, and that when those earnings actually come in, they're lower than expected, and then prices correct and we lose money in the short term and we're all sad, right? But what has happened over the last 18 months since March of 2020, people have been underestimating earnings pretty regularly, underestimating how strong companies are and how well they're doing. And in 2021, what that has meant is people have not been fully invested over that period of time, because the expectation was that US stocks were going to struggle because of COVID, right? And because there's a global pandemic going on, hello, right? And all of these very serious challenges in the market. But what has actually happened is every quarter, when companies report profits, they keep breaking records. There's record-breaking profits. And so, like, not completely across the board, but it's been really, really common to underestimate profit growth over the last year and going on 2 years. So here, if we're looking at this, the stock market is going up in anticipation of earnings coming in at these levels. If earnings come in lower, you might expect the stock market to fall. But if they come in higher, you would expect the stock market would have to race up to now meet those new higher earnings expectations. Did that answer your question?
Yes, thank you.
One of the things that I usually point out and kind of forgot to this time, going back to that question, Amy, is if we come all the way back here to this part of the chart where the white line went up way faster than the gold line, this was the dot-com stock market bubble of 2000, 2001. So if we go back to this period of time, you can see that if you remember what was happening then, it was the internet is going to change everything. Lots of companies are going to be born and make lots of money because of the internet. And people got really excited about that new technology. And so prices went up and up and up as people started looking towards this new future. I mean, but what happened is investors got ahead of themselves. They started imagining a more and more profitable future, but then the profits did not come in as high as people expected. So that is what a bubble is if those prices keep moving up and up and up away from earnings, that's what a bubble looks like. And it's not just in the stock market, in the real estate market, if prices of real estate pull up and up and up and away from rents, which is kind of the core underpinning of real estate, you can also have a real estate bubble. You can have a bubble in any type of asset. So this is the fear, rightfully so, that a lot of people have. It's this idea of a bubble. Do you want to buy into a bubble, right? Because if the price is much higher than the earnings, and the earnings don't go up like expected, you're going to suffer a decline. Eventually that will correct itself. And a bubble bursting is usually pretty dramatic, right? So this was a 50% decline from kind of 2000 through 2002. Very, very painful to get through the bursting of a bubble. So that's, I think, when people, almost always when people express concern about the current stock market, and rightfully so, this is the reference. It's that we're in a bubble, right? The prices are at all-time highs. There's no justification for it. And so it's a bubble that needs to burst and come back down to more reasonable levels. What I will say is that, again, like over the last 12 to 18 months, instead of overestimating earnings, people have underestimated it. That doesn't mean that continues to happen over the next however long, right? Past performance is not indicative of future results, but it's the other end of the coin, right? That you can get caught behind the stock market. The stock market's already moved up. Well, now what, right? I am of the opinion, this is just my opinion, right? That the US economy, US companies, and the US consumer are in very strong positions, right? I don't know if that's a widely held belief or not, but it's mine. Consumers have record low debt. That's not something that we hear about all the time. I wish I had a chart to show you that. I have a chart if you want to email me about that, right? There's record low debt or near record low debt for consumers. There's near record low debt for most companies whose shares we can buy in the publicly traded markets. There's record debt for the US government, right? So that's kind of the downside over here for a lot of people. But here in the stock market, we're talking about companies, and we're talking about companies whose customers are us, right? So if we're in a strong position and we have jobs and we have savings and we have money to go out and buy goods and services, the companies that we are then sending that money to, they should be able to do well and generate profits. So if I'm looking at these earnings, if we would have looked at this a year ago, and we did, like all of these boxes have been moving up over that period of time, right? Because it's almost remarkable. I mean, it is remarkable how quickly US companies recovered from the very short and severe recession in March of 2020 and are now in relatively good shape. All right, I'm gonna stop again because I'm assuming there's some more questions.
So Angie has a question about something that you just touched on really briefly. She says, I hear many people insisting that all of the stimulus that has been happening, some people refer to it as the Fed printing money, that will only lead to disaster long-term because it causes inflation. What are your thoughts on that?
Yeah, that's an awesome question. So again, my personal view on it is that it's not that simple. And that was the narrative since 2008, the financial crisis, right? That quantitative easing and this idea of the Fed printing money and pushing money into the system causes inflation. We have not had until very recently, and I have this on a slide coming up, we haven't had inflation. There are no numbers to support that narrative. So that would be the first thing, is like, yes, it seems intuitive to say that, but if it was that simple, then we would have numbers to support that narrative. And that's one of the, like, we just don't have numbers to support that narrative. Only very recently, like in the last quarter or two, have there been high inflation numbers, but off a very low base from 2020. So that doesn't mean that can't change in the future, right? But the narrative is not that simple. Economists and certainly market participants do not have a good understanding of what causes inflation. That is absolutely true. There are a lot of theories. I just listened to this really great podcast. I think those of you on the Facebook group, I think maybe know that I listened to this podcast in Bloomberg called Odd Lots podcast, Odd, O-D-D, Lots, L-O-T-S. And just 2 episodes ago, I think, they did a whole episode on inflation and the idea that economists don't have a good theory of what causes inflation. So what I would say is maybe, but maybe not. It doesn't seem like there's a lot of evidence to support that narrative as it was laid out. But I hear it all the time too, right? And I think it seems like it would make sense. It doesn't really make sense why it doesn't lead to inflation, but it hasn't. So I think I kind of danced around the answer, but hopefully that was helpful. What else we got?
I think that's it for now. Angie, did you have a follow-up to that? Or did that answer your question?
Those are really good questions, you guys. Thank you. And exactly the right questions to be asking, I would say too. All right, we'll keep going. All right, another one of my favorite charts, risk versus expected rate of return. So if we come up here, this is just the stock market, right? So just stocks as an asset class. And if we're looking at this white line, which is the price of the S&P 500, we see that yes, over long periods of time, it's trending upwards. So it's growing, but there is a lot going on in the short term, right? Lots of peaks and valleys and crashes and long periods of time where it's going sideways. So in the investing world, the way we measure this volatility is through a metric called standard deviation. So here on this chart, we can kind of put the stock market in context with other options for your investing dollars. Here on the bottom axis, which is the x-axis, I think.
Wait, I want to interject.
Yeah.
Standard deviation is something a lot of people don't usually hear. So do you want to give just like a short description of what that is?
Yeah. So in investing, we use it as a measure of volatility. So what standard deviation is measuring is from year to year, in this case, how far are the actual results from our expected results. So over long periods of time, we expect stocks to have an average annual rate of return of 9% or 10%, depending on what time period you're looking at. But that's over a long period of time, right? Oh, sorry, a long period of time. It might take you a while to get there. From year to year, the stock market's actual returns tend to fall in between 10% plus the standard deviation here of, let's call it 17. So your actual rates of return from year to year are 10 plus 17, or 27%, or 10 minus 17, which is negative 7%. So that from year to year, that's a really wide range of outcomes. You might fall between, I usually say plus 20, minus 20. But we know that some years the market might be up 25 or down 25. So in the short term, your range of outcomes is very wide. But as we go along through more and more and more years, the market has converged towards this 9-10% number over long periods of time. So the standard deviation measure is telling us how volatile our price is in the short term. Do you think that was helpful, Lori?
Yes, I think so. That helped a lot.
Yeah. I think about it, how stocks, going up and down in the way that we all know stocks go up and down. That is a hallmark of stocks, for sure. That is what the stock market is known for. It'll always be known for that. That's what it does. So our standard deviation, or that measure of risk, is another way to say it. That measure of volatility is on our x-axis across here, from low risk or low volatility assets up to high risk, high volatility assets. And then on the y-axis going up, we have compound annual returns. So this is our, over long periods of time, the compound annual growth rate of these different types of investments. So said another way, these two asset classes down here, can you see my my arrow when I'm moving it around? Or am I, okay, so I'm not just moving it around to myself, great. So down here in the bottom left-hand quadrant, we have cash, which is just, I think it's very short-term treasury bills, and aggregate US bonds. So these are very low risk, very low volatility asset classes. And in return, you also don't get that much. You don't get a very high rate of return for not taking very much risk. Cash is very stable, right? Bonds are relatively stable. They're riskier, more volatile than cash, but they are, in the grand scheme of things, not that risky. We come way out here to the upper right-hand quadrant. This is where stocks are, right? So this diamond here, large US stocks, this is the S&P 500. Here we have small US stocks, so that's the Russell 2000. And here we have real estate, which just, like, I know we've got a lot of Austinites on the call, but this is commercial real estate. This is not your home, right? It's commercial real estate. So just take that for what it's worth. These types of asset classes, you can kind of think of them like the boom bust asset classes, right? They can go up really far, but they can also fall really far from year to year. So that's reflected in the higher volatility. But over longer periods of time, so this goes all the way back to 1995 through 2020, over that 25-year time horizon, large US stocks on average returned let's call it 9.8% per year on average, but with quite a bit of volatility. Same for US stocks generally, same for commercial real estate. So in exchange for withstanding that volatility, being able to get through the short-term volatility in order to realize the gains over time, you're compensated with a higher rate of return. That is what we should expect going forward. We should expect these relationships to hold over long periods of time. Otherwise, no one would invest in companies. No one would buy stocks or invest in companies if they didn't think they would get a higher rate of return over time than if they just put their money in cash or bonds. We can see here, though, there are some asset classes where this relationship for US investors has not held up as well. So down here, this diamond, we have non-US stocks. So these are international companies, companies that are based outside of the US. So over the last 25 years, non-US stocks, you've gotten all the volatility that comes from stocks, but you haven't gotten the same rate of return that you would have had you chosen US stocks. I think that's kind of interesting, right? This is just something to note. Again, past performance is not indicative of future results. It's just, again, these are just the numbers, right? If we come way down here, I don't know, you may have, I missed this diamond the first time I looked at the slide. Down here, we have commodities, right? Commodities are raw materials. So in Texas, we certainly think oil and gas, right? But things like corn, wheat, these are things that are usually grown or taken out of the earth and then used up, right? So they go into something else. Commodities, if you had just bought commodities 25 years ago and held on to them, you would actually have a negative rate of return and with way more volatility than the stock market. So again, just take it for what it's worth. These are just numbers on a chart, right, that we're trying to use in order to make projections about what we think going forward. And then here, right in the middle, we have something called the equally weighted diversified portfolio. So most of us, when we're investing, we have a little bit of everything in our investment portfolio. Most people aren't 100% stocks or 100% cash or 100% commodities. Most of us have a nice mix of things, right? Not putting all of our eggs in one basket. So this is showing like, okay, if you put 14% of your portfolio in each of these asset classes and then rebalanced it every year, you would have a portfolio that got, some of the upside of these riskier assets and with way less volatility. So you get a little bit more upside than being perfectly safe, but you get a lot more stability. So that's the trade-off. Any questions on this chart?
I have a personal question.
Oh, I love it. Yeah.
Where would you put like up and coming or emerging asset classes like cryptocurrency?
Oh man, that's a great question. I mean, I would like probably not even be able to include them on this chart because we're limited to like a 25% annual volatility, 25% annual volatility and 12% annual rate of return. I'm a believer in cryptocurrency and digital assets as an asset class, even though I have no idea what that looks like in the future. So I would put it in, like when we think about range of outcomes, I think maybe Gwen, I said this to you the other day, like I would put it like your range of outcomes and something like that is somewhere between like negative 99% and plus 1,000, right? So like the range of outcomes is so wide right now because it's such a new asset class. There are lots of people who think it's not an asset class at all, so I will concede that point. But if I had to put it, I would put it like way over here, like higher than a 12% annual expected rate of return, but way higher than 25% volatility. So it'd be like off my computer screen, like kind of just way over here. It'll be interesting to see like what the track record starts looking like with it, right? And maybe it eventually becomes a diamond on this screen, like as we get just more time behind us. Because over such a short period of time, it's interesting, but difficult to chart against asset classes that have a longer track record that we can look at. I mean, and some people say it should be, off the screen down to the floor, right? Like off the right-hand side of my screen down to the floor because it's going to go to zero and you're going to lose everything, or it's going to go to negative 100% returns, right? And with lots of volatility. So that's a really good question. Anything else on this chart? All right, I'm going to keep going. Keep thinking of those questions though, because we'll have time at the end, I think. Okay, so we're coming back to good old Uncle Warren. Here's another great quote. You shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. So, this one, he's talking about a 50% decline in the stock market. If we go back up here, here's a 50% decline when the dot-com bubble busted. Here's another 50% decline when the real estate bubble burst and there was a financial crisis caused by it. 2 times in the not super recent past where the stock market has declined 50% in a very short period of time. I think this first one was, I think this probably happened over the course of 2-ish years. And I think the financial crisis, it happened in the period of like 16 months, right? So that is a big decline in a short period of time. And then of course, if we come over here to March of 2020, the S&P 500 fell by 34% in 3 weeks, which was just intense, right? That's the fastest bear market we've ever had. A bear market is when the market falls by 20%. So fastest bear market, also fastest bull market. It turned right around and got back to its highs, definitely by the end of the year. So that's where we come back to like, okay, if you're in the stock market, these things are not common, but especially if you have a 30-year time horizon, there will be intense recessions and intense bear markets and crashes over the course of your investing life. That's just the way markets work. So if we look at the role of stocks in our portfolio, So now we're getting into like, okay, well, how do you use this information to make investing decisions for yourself? Here, let's see, we have this chart that goes all the way back to 2005, right? The green line is the S&P 500, and the blue line is just a regular bond fund, the Barclays Ag. I think this is the iShares Aggregate US Bond Index Fund or something like that, AGG. So if you had played it perfectly safe, not perfectly safe, but pretty safe in bonds, then you're the blue line. You can see how stable bonds are. You're lending money to someone and they're paying you back a little bit of interest over time. You almost always get paid back. So bonds are a very stable asset class, and we can see how stable it is. You know, if you'd invested in bonds from 2005 until today, your investment would be up 15%, not quite 15%, and you would have received interest payments on top of this. If you'd invested in stocks, you would have seen the stock market go up into 2007, then crash by 50% in the financial crisis, and then claw its way back over 5.5 years of pain to get back to where you started in 2013. And then the market goes up, and sometimes it goes down and sideways, and goes up and down and sideways. We have March of 2020, and after all this in the stock market, you're up 280% plus from your original investment. But you had to get through some pretty intense periods along the way. That's the hardest part, right? That's also the price of admission. You can't skip those things. Almost no one can. Maybe you can skip one by making a good call, but you're going to have to just look at how many things you would have had to skip over in order to make this line perfectly smooth. Right? So that shouldn't be your expectation, but it should be your expectation that when things go wrong, some companies, a lot of companies during the financial crisis ceased to exist. They just got flushed out of the system. But a lot of new companies were born. And eventually those companies figure out how to make money and the stock market comes back. Same thing in 2020, right? Some companies failed, not as many as most people thought, because stimulus money came in and saved a lot of companies that otherwise would have gone out of business. But the end of March and going into the end of 2020, those companies figured out how to start making money again, or how to expect to start making money again in the not too distant future. Companies don't have to be making money right this very second. There has to be an expectation that they will in the future for their stock price to change. So most of us, if we're trying to accumulate wealth over time, most of us need some, if not most of our money, closer to this green line, or otherwise we're just not going to end up with a large enough nest egg to sustain us during retirement when we're not earning money anymore. So this green line is for wealth creation, and it requires long periods of time to get through the dramatic volatility. The blue line, bonds, are for stability. So everybody will have like a personal preference as to which one they'd rather be closer to. Would you rather be closer to the blue line, but maybe with some upsides, so some of your money can be growing? Or would you rather be closer to the green line? Maybe you want to just be the green line, or maybe you have 80% of your money in stocks and 20% in bonds. So you have some stability, but you're mostly close to the green line. This is what like this group is for, is trying to answer those questions for each person, and every person is going to be different. Are there any questions on this?
Yeah, so Lori had given, I think, a good answer to Melissa's question on, can you explain bond funds? But Sarah, if you wouldn't mind weighing in on that too.
Can I explain just a bond fund or this bond fund?
What is a bond fund?
Yeah, so bonds are, you can think of them like loans that you're making to a company or a country or a city. A bond fund, whether it's a mutual fund or an exchange traded fund, a bond fund is a collection of all these different bonds. So one of the features of a bond is that like it's actually an IOU. You've lent someone money, and that entity now owes you money back. If you have just one bond, you're exposed to the risk that one company just declares bankruptcy and they just don't pay you back. The benefits of a bond fund are that instead of owning one bond, you own thousands of different bonds in a basket. So think of this like a AGG is a big basket of all different types of bonds. Some are very safe, US Treasuries. Some are very risky, junk bonds, lots of bonds in between, but the basket tends to stay pretty stable over time. Good question.
And then Azucena had a really good question. Would you expect this mix of stocks and bonds to change as we get closer to retirement?
Oh, yeah, that's a good one. Usually it does. I would say usually people move away from the green line and start wanting more of their assets closer to the blue line. And that is important once you start taking money out of your accounts. If I know I'm retiring this year, and I also go back here and I know that the stock market can go down and stay down for a while, right? So I think this was 5.5 years here. The way I think about it is, okay, if I am retired and I'm no longer trading my time for money, I still need to pay the bills, right? And if in a really bad case scenario, the stock market is down for 5.5 years, I should have a pretty good understanding of where money could come from for 5 years in order to keep me safe and in order to keep me from needing to sell stocks at a loss. So for that reason, most people start accumulating money in these safer asset classes, right? Because then if the stock market's not cooperating, it doesn't really matter. You just wait for it to work itself out over time. But while you're waiting, you have resources to draw out of, either cash or bonds or something relatively safe. So most people do tend to get more conservative. I have seen on a handful of occasions, I'll have people it goes the opposite way. It's usually people who end up with a much larger nest egg than they expected. And they view the larger nest egg as having room to be more aggressive, right? Like, oh, like my nest egg is bigger than expected. Especially if you don't need that much income. If you have a big nest egg and you're relatively frugal, you can have, theoretically, you could have a higher percentage of your assets in riskier asset classes. That's not very common though, but it's not unheard of. Really good question. Should I keep going? Are there other questions?
Yeah, Amy had, she had a thought that I thought maybe would be good to discuss after you finish your slides, but she said Amazon spent a long time not making any money and that stock went crazy high, which is a perfect example in investors believing in its potential. So maybe I'm the only one that has the question, but maybe after your slides, we can talk about like, you know, how long do you hold and kind of wait and believe in something's potential?
I mean, individual stocks. Okay, so the question is how long to hold?
That's my question, yeah.
We've talked about this. I think we had an Austin Women's Investing Group meeting on when to sell, which was really interesting. It is really hard with individual companies. It's a lot easier with just like, this is the S&P 500, right? And so like when I'm thinking about stocks in general, I tend to start with the assumption that we're never going to sell these stocks, right? And then I'm like, okay, well, that's not realistic. Eventually we need money, right? So if you ratchet that down to, we only sell when we need the money and when the price is good. If we don't need the money, we don't sell, we let it ride. If the price isn't good, we should, kind of going back to the previous question, we should have some safer assets set aside that we can draw out of when the market's not good, when the stock market is not good, right? So then it becomes like, okay, well, we sell when we think we have a good price and we need the money, or we sell when we're thinking we're getting a good price in order to put that money in a safer bucket for something like retirement or college expenses, or I'm going to buy a new house, or I'm going to whatever, right? Like, you know what the money is for, not just, and the other way to think about it is if you have a diversified portfolio of 80% stocks and 20% bonds, you sell some stocks when your allocation gets higher than your target. So if your starting allocation is 80% to stocks, and then the market shoots up and all of a sudden you're at 90% stocks, then that should be a sign to sell some of those stocks, put them into something safer, and bring your portfolio back into alignment. For individual stocks, it's way trickier than that. With individual stocks, the time to sell is either when the price is way higher than you ever expected and you think it's too high based on some sort of analysis of the company, or the company has changed so much and you don't think, maybe it's fallen and it's, nothing is working out the way you thought it was going to, and you don't think that things will change, and you just take your losses, take your lumps, take the proceeds, and move on to something else. Really good questions. All right, I'm going to keep going, but keep the questions coming. I think we'll have plenty of time at the end. So this is just a shorter time period, just kind of zooming in from kind of towards the end of 2020, or sorry, the end of 2019 through the beginning of 2020, showing that decline in March of 2020, how severe and fast it was. And I'm guessing if you're on this call, you were there, you remember, right? That it was really intense, right? And it was really scary for a lot of people, and compounded with the fact that we were dealing with a public health crisis as well. But eventually the stock market stopped falling, and almost as fast as it fell, it rebounded, right? So this is like a perfect example of a whipsaw. Just as soon as you sell because you think that it's going to keep going down, there's a point at which sellers in the stock market become so despondent that kind of everybody just like gives up. And it can kind of happen at the same time. The word we use is capitulation. When do people capitulate, right? They just can't take it anymore, right? And just the news is so bad, and it just looks like it's going to get so much worse. There are no green shoots. You can't possibly see how things are going to be different in the future from what they are now. It tends to be the period of time when people say, well, I'm going to sell now because I know it's going to keep going down, and then I'm going to buy in after it falls more, right? People tend to kind of make those decisions in groups, so it's easy to do it. And so here, March 23rd was the low. That was the day that the Federal Reserve came in and made their announcement that they were going to support the bond market. And then right on the heels of that is when Congress passed the Secure Act. So those things happened very close to each other. Sort of unexpected. The Fed and Congress had been telegraphing they were going to do it, but you wouldn't probably be paying attention to that if you weren't in the financial markets. But right after that happened, markets rebound. And of course, like, it's not a perfect straight line up, but this was a really fast recovery. So you almost didn't have time to get back in once it took off. So this is where, like, this is the danger zone of the stock market, because you think you know something. And the stock market is so complex, and there are so many people and so many factors and so many inputs, and it is so complicated and it moves so fast that as soon as you start narrowing your timeline, it's really easy to fall into these traps. Whereas and I think we talked about this on the call with the stock market, if you can just take a minute and zoom out and say, do I think things will be different in 5 years? With this particular crisis, I kept coming back personally to, okay, I kind of trust that science and technology and the medical profession, we will figure out either a way to live with this virus or to eradicate it or something in between. So things 5 years from now are going to look really different to what they are now. We're not going to be on lockdown for 5 years. So you don't have to know exactly how that's going to happen or when it's going to happen, but I find that to be easier to zoom out and say, okay, well, what might the world look like in 2025 or 2030? If the answer is better or a lot better, then okay, take a step back and just let things run their course instead of trying to jump out and jump back in and jump out and jump back in. It is really, really difficult to be on the right side of those moves. So again, like this is like the danger of the stock market for sure. And so we've seen that in the very recent past, like how that can trip people up. Any questions on that? If Caitlin's on the call, I've left these slides in for Caitlin. I'm just going to kind of go back now. If we're talking about like why you're making the choices you are to either invest in stocks or not invest in stocks, I like to run through the numbers at this point just to show the impact that these decisions have on your long-term wealth accumulation. So I know most of you have seen this before, but for the people who haven't, I'm going to run through it again. So we're going to do like 4 different scenarios. Up here in the upper left-hand side, let's say, let me back up a minute and talk about time value of money. So time value of money is the set of calculations we use to explain the concept of compounding, right? The idea that your money grows on itself over long periods of time. There's an exponent in time value of money, so it's exponential growth, which is very important. There's 5 inputs in time value of money. We have present value, which is what something is worth today. We have rate of return, which is that compound annual growth rate. How fast or how much do we expect something to go up or down in value over time? Payment, when we're saving for retirement, this is usually a positive number, like the amount we're putting into our retirement accounts. When we are in retirement, it's a negative number. It's the amount of money coming out of our retirement accounts. Number of periods, in this case, I'm going to use number of years. And then future value. So what we expect something to be worth in the future. So the way I've set this up is I've made assumptions for the first 4 inputs, and we're going to solve for future value. So let's start with $10,000. Let's say you have $10,000 in the bank, and you're trying to figure out how to invest it. And you've identified one type of investment, relatively conservative-ish, that you expect to get a 5% rate of return over time. You're not going to put any money into this account, but you're not going to take any money out. So you're just going to leave the $10,000 in there, and you're going to let it grow for 10 years. So if this all works out the way you expected and you get your 5% rate of return, you'd expect to come back in 10 years and you have $16,289, right? So that $6,000 gain it's your return on investment. So way to go, you made money. We come over here to the upper right-hand side, it's the same inputs, but now we're going to let it grow for 30 years. So we're going to let time run its course. If we plug those numbers in, your future value at the end of 30 years is $43,219. Just awesome, right? You went from $10,000 to $43,000 over 30 years. So now let's come down to this bottom left-hand corner here. So now we're going to make a different decision. Instead of an investment we think will get 5% over time, we're going to target something we think will get 10% on average over time. And so let's say we put our $10,000 in this investment, we get a 10% average rate of return, and we do it for 10 years. When we come back, we have $25,937. So that should totally make sense, right? Because it's a higher rate of return, so you should have more money than the 5% rate of return up above. So now over here in the bottom right-hand corner, we're going to take this $10,000. We're going to keep it in an investment that we think will get 10% average annual rate of return. But now we're going to do it for 30 years. So when we run these numbers, we come back in 30 years and we have $174,494. And so I always run these slides and these scenarios in this group Again, because we are trying to figure out how to invest our money. So we should know what the expected outcomes should be from the decisions that we make today. If you tend to be a more conservative investor and you want to have more money in bonds and cash and safe asset classes for whatever reason, your investments are not going to grow as much. So to get to the same nest egg amount that you need for a comfortable retirement, you're going to have to save more money, right? Down here, this bottom scenario, here we're really relying on investments to do a lot of the heavy lifting. This is a huge difference. It seems in our brain, people say, oh, if you get a 10% rate of return, instead of a 5% rate of return, you should end up with twice as much money. But it's way more than that because of exponential growth. So here, you rely on your investments to do more of the growing and to grow your wealth. But in exchange, you have to be able to tolerate the volatility because it's not a free lunch. You don't get 10% for nothing, right? You get it because of the volatility of stocks. I'm going to stop for a second and see if anyone has any questions here. I was telling Gwen the other day that I run these numbers a lot in my office, on the whiteboard behind me when people are in the office or on an Excel spreadsheet for people, so that I can give people a really good idea of the dollar impact of their decision to be more conservative or more aggressive, right? And a lot of people, once we run the numbers, they'll come in and they'll say, well, I'm pretty conservative. So we kind of put in the lower rates of return over time, kind of come back to, this chart here and say, well, okay, maybe we get like a 6 or a 6.5% rate of return instead of 9.5 or 10. But when they see that over long periods of time, that decision to be more conservative can lead to a difference in hundreds of thousands of dollars or sometimes millions of dollars, it at least gives them a chance to say, oh, like that's a much bigger difference than I thought it was going to be. Maybe we decide to be a little bit more aggressive because now we understand why, or no, like we are relatively conservative. Now we know maybe we need to save more money instead of taking more risk with our investments. So like it has very real world actionable outcomes for running the numbers and at least knowing conceptually how to tweak these inputs in order to get the outputs that give you good information on how to make decisions. So time value of money is a big one. You don't have to exactly know how to run the numbers, but I think you do have to have an understanding of how large or how small differences, especially in rate of return, and large differences in number of years, and sometimes small differences in number of years, how they add up over time, so that you know what could happen by making these types of decisions. All right, I'm going to keep going. So I'm finally getting to the point where I'm going to talk about what I think are the fundamentals of investing through the end of the year and going into next year. So this is where, like, some people might not be super interested in this. Some people might be interested in it, and some people might have alternate views for me, which I would love to hear. But this is like, as I see it, the concepts to keep in mind as you're making decisions, if you're making decisions in 2021, 2022 about how to invest your money. So the first one, and some of these are the same that they were when we talked about this in January. The first one is the return of TINA, T-I-N-A. TINA stands for there is no alternative. How often do I hear the question, I have X number of dollars in my high yield savings account doing nothing. How do I put it to work? The answer is there's no alternative. There's no safe alternative with a high rate of return. You can get maybe 0.5 or 0.7% in a high yield savings account if you work really hard. If you're with one of the big banks, you're at 0. If you invest in a bond fund, maybe you're at 2, 2.5%, 3%, but those numbers are not compelling, right? They're also not numbers that are going to make anyone any money. So what that does is it forces investors out of those safe asset classes and makes you consider riskier asset classes with higher rates of return. And it's not just you, it's everybody, right? Everybody is doing this. We're all in the same boat. We're all looking at the same expected rate of return for safe asset classes and trying to figure out if it's worth it for us to put money at risk for 5 years, 10 years, 20 years, because we're getting zero in savings. So TINA is very important, again, because it's not just you. You're not the only one with this problem. Everybody has this problem. Everybody, like globally, it's a global problem. So it's really important to know that it's just how the world is. Another kind of phrase we use is don't fight the Fed. The Federal Reserve is setting short-term interest rates, and they have said very clearly that they are going to leave those rates very low until they see reason to raise them, which would mean that like inflation starts maybe getting way too hot or the economy starts overheating. But there's a really good chance that they don't even look at increasing short-term rates until the end of next year. So if you're chilling out and you're waiting for those 3% savings account yields to come back, you're going to be waiting a long time. On the flip side of this, low rates benefit borrowers. So if you're a borrower, you're still in a low interest rate environment. If you're getting a mortgage, if you're getting a small business loan, a personal loan, rates are still relatively low for borrowers, but they're also low for lenders. And so that's tough. One of the other trends, right, is this strong economic recovery that a lot of us underestimated. So COVID vaccines, as more and more people get vaccinated, more and more people get out into doing kind of what the new normal looks like, out spending money, buying goods and services. That's good for the economy. 70% of our GDP in the US is driven by the US consumer. So that means if consumers are strong and consumers have money in their pocket, in the aggregate, our economy should continue to grow. Stimulus coming out, they passed more stimulus, and now they're talking about an infrastructure package, right? Again, this is money coming into the system that we're going to pay people to, build roads and bridges and broadband access to everybody, right? Like those people that have jobs have money in their pocket, they turn around and spend it. Like that spending aspect is the lifeblood of the US economy. You don't want people to start hoarding money and keeping it in their pockets. You want it to be moving through the economy. That's what causes the growth. Inflation fears return. So this is a new one, right? Just over the last couple of quarters. The big debate is inflation temporary or is it permanent, right? So this kind of goes back to the really good question about, is the stimulus causing real persistent inflation that is going to cause us to change our spending habits, or is it temporary because of supply chain disruptions or just like weird after effects from 2020? And no one knows. The Federal Reserve thinks it's temporary. So they think that these high inflation numbers that are coming out year over year are going to moderate and come back down. There are people who think that it's going to be permanent and that, we've been living in a world where inflation rates are below 2% since the financial crisis. So that's been a long time. People are used to low inflation. If we had to change and get used to higher inflation, what rate of inflation makes us change the way we do things? And what effect does that have on the stock market, the bond market, the real estate market, whatever? They're unknowns. We don't know. But inflation is one of those things, and inflation expectations can ripple through the markets very fast, right? And with pretty dramatic effect. One of the things that happened this year is growth stocks especially. So these are stocks, these are companies that are growing that maybe aren't very profitable today, but we expect them to be much bigger companies and much more profitable companies in the future. So Amazon, Tesla, Netflix, these are companies that don't actually earn a ton of money right this very second because they're still trying to grow bigger and bigger and bigger. But a lot of people expect them to be even larger in the future. Growth stocks have had a rough 2021 because as people's inflation expectations go up, they're not willing to pay as much today in the present for earnings that they expect to get far into the future. So it's actually like a time value of money calculation thing that is not, again, not intuitive. But a lot of those growth stocks that we all know and love and have gotten used to, going up by X% per year, they really got whacked this year because inflation started becoming a calculation that investors were doing in a different way than what they've been doing before. So this is kind of a new one. You have to kind of keep an eye on people's changing expectations about inflation. And it's really tricky, again, kind of going back to we don't really know what causes inflation and what causes disinflation and why sometimes we have inflation and sometimes we don't. It's not intuitive, but it's something to keep an eye on, right? It's one of the factors in the stock market. And then this fourth one, and this was I had this in here from when we talked about this early in the year, it's the rise of the retail investor. This has been for me, the most unexpected thing that came out of 2020 somehow was this phenomenon of watching so many of you and so many people who were not active in the stock market becoming really active in the stock market over the last 18 months. And I think it's really fun to see it happening. It's like democratization of investing. But at the same time, the new retail investors, they act in unexpected ways, right? Never before February had people read Reddit threads to decide what to invest in, right? Or they did, but it didn't have such a huge impact on the market, right? So that's all very new, which is exciting and strange and scary at the same time. This one at the very bottom, this one I think is actually kind of important. As people have money to invest, and there's still money on the sidelines, from small investors to large investors. I think that what that means going forward is that the dips that we get can be very, very short, in duration, and they seem to be getting shallower and shallower. That doesn't mean that eventually there's not some break and some sort of 10%, 15%, 20% decline in stock prices, but we've been waiting for that for a long time, and it keeps not happening. It seems like whenever the market falls, you have a lot of investors come in to buy the dips. And by having that many investors coming in to buy the dips are very short. So you might only have, if you're a buy the dip investor, you might only have a day or two, maybe a week sometimes, to buy the dips before everybody else starts buying the dips too, and it drives the price back up. So that's been a very tricky thing to be in 2021, is a buy the dips investor, because the dips are short and relatively shallow. I think I heard the other day, I was watching Bloomberg, and they were saying that we haven't had a 5% pullback in the S&P 500 since October. I mean, it's almost October 2021, right? That's almost a year. The stock market has not pulled back more than 5%. It's really wild. The NASDAQ has, which is tech heavy, but the S&P 500, the broad measure of the stock market, has been pretty steadily going up. So just, take it for what it's worth. And again, here I'm talking about the fundamentals of investing in 2021 and I think into 2022. But if you don't want to think about it in the short term, just know that you don't know how to predict where the stock market is going to go, right? So this goes back to 1957. I know some of you have seen this before. It's showing the S&P 500 back to 1957 and just kind of marking out all of the bad things that have happened since then. I mean, today, of all days, right here, 2001, the World Trade Center attack is here, right? I think, again, like as investors, we worry a lot about the effect that things are going to have on the market. And when it comes down to it, the stock market only cares about money. It only cares about earnings. There are a lot of really bad things that happen that don't affect profits or earnings. And that can be a tough thing to accept, but it's true. So if something bad happens and it doesn't have a broad effect on companies and their ability to make money, it won't have a broad effect on the stock market. So just kind of keep that in mind. That's something that comes up over and over again. Every election cycle, it's like, oh my gosh, if this side wins, this is what's going to happen. It's going to be terrible for the stock market. And it doesn't matter what side you're on, right? It's the same narrative over and over again. And by and large, the stock market doesn't care what political team is in power. They care about consumers having money in their pockets to spend. They care about people having jobs, because all of those things are related to money and the way money flows through the economy, right? Like maybe a little bit taxation, sure, right? But even that doesn't have as big of an impact as I think people think it does. What the stock market wants is economic growth, money in people's pockets, people having jobs, and companies being able to have relative freedom to innovate and create goods and services and generate profits. Anything else doesn't really affect the stock market. So even here, like the World Trade Center attack 20 years ago, a recession independent of that was already happening, right? So the recession caused the decline in the stock market and the popping of the dot-com bubble, not the terrorist attack, right? So just kind of keep that in mind, that if you get really kind of bogged down in trying to predict when the perfect time to invest is, there's never going to be a time where all of these problems are solved and there's no risks on the horizon. Like that's just not the way humans work, right? There's always something that is about to happen or that we're afraid is going to happen. So that like perfect like green signal is never going to flash. So you just kind of have to trust that, okay, if we have a long enough period of time and we give companies time to work things out and we give our economy time to heal, it can overcome bad things. So those are the slides I have. So now I'm happy to take questions that are either related to the things that I talked about or unrelated. I would love to hear what questions are on people's minds.